Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. We've got a real treat for you today. Jeff Hirsch is going to be joining us. Jeff is the editor of the famous Stock Traders Almanac. He's an expert on stock market seasonality, and I can't think of a better time to be talking about seasonality, so we're really lucky to have him on. But before we talk to Jeff, it's Friday. The markets are closed for the week, the month, and the quarter. So let's take a quick look at how it all played out. Hey guys, thank you for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so all four major indices closed lower on the week. The Russell 2000 fared slightly better than the rest, dropping about 1.5% on the week, while the others dropped about 3%. Now, taking a closer look at the S&P 500, it closed lower for the third straight quarter for the first time since 2008. We closed below those June lows that we've been talking about for weeks now, so there's really nothing bullish about that. However, we are sitting on the 200-week moving average, which has acted as support several times throughout the past decade in 2011, 2016, 2018. So it'll be really interesting to see if that holds over the next couple weeks. If it doesn't, watch out below. Anyways, enough from me. Let's welcome Jeff onto the show. All right, Jeff, welcome to the show, and thank you for coming on today.
Great to be with you, Patrick. Thanks for the call.
Yeah, I mean, I have been a fan of the Almanac for years. I actually put it on my Christmas list every year. So I have a stack of these at home going back to like 2015, just piled up. And so it's great to have you on. It truly is an honor to talk to you. Let's get right into it. It's obviously been a pretty wild year so far. Here we are in a bear market. You know, you got inflation's crazy. We might be in a recession. Who knows? And in that kind of environment, you know, there's some people that would say seasonality and these cycles don't really matter. You know, it's so different this time. So I'm wondering, what do you say to those critics that say it doesn't matter right now?
I mean, it's always different. Nothing's exactly the same, but humans are habitual creatures. The root of, behavioral finance is what people do on a regular basis. And from our research, and I know from what you've looked at and other people out there, while seasonality doesn't work 100% of the time, I mean, my joke is that nothing works 100% of the time. I don't work 100% of the time. I sleep sometimes, but it continues to work. I mean, we'll talk about our best 6-month strategy, but that works. Not every single seasonality works. And yes, there are extenuating circumstances. But when you find yourself in a year like this year where, seasonality didn't work from last November to April. But that's an indication in and of itself. When bullish seasonality doesn't work, there are other factors that are stronger. And when the seasonal period's over, those factors are going to have their say.
Yeah, that's kind of how I've kind of always thought about it too. You know, we know what's supposed to happen. And so when it doesn't, like you said, it's an indication that whatever underlying trend is there is unusually kind of powerful at the moment, right?
It is, but the seasonal trend, the seasonal patterns are powerful. They do shift, and that's what we've been doing for over 5 decades, is tracking some of those shifts. We've seen things happen. The mid-month spike was a great discovery that I witnessed or sort of, discovered with my father back in the early 90s, when you started seeing the impact of the payroll deductions going directly into the funds through retirement accounts and 401ks. So yeah, they shift, but the empirical evidence is there. I mean, it's evidence-based.
Yeah, and I know you've touched on this before. This is probably where I've gotten it from, but I think you pointed out, if you look back 100 years ago at these seasonal patterns, when the United States was a more agrarian economy, more farm-based, a lot of it followed the harvest, right? The stock market returns kind of followed the harvest. Is that right?
That's my line. You're You're quoting me. No, it's true. I mean, we have a chart. I don't know if we could share it at some point, but it shows the 1 year seasonal pattern going back to 1901, which is where we have really good data, that we're comfortable with. And from 1901 to 1949, it looks like buy in May, not sell in May. And then since 49, since World War II, you see that rally from September, October, November into April, May, June, pretty much mostly November to April. And it's the same. We use post the 87 crash when the systemic changes kicked in, but it's there. Before World War II, it was a harvest driven, economy and market, as you just said.
Yeah, so that brings me to today. Here we are kind of in the eye of the seasonal storm, and not just seasonality. A lot of these seasonal trends have been working against us. For example, here we are at the end of September. It's notoriously the worst month for the S&P 500. And a lot of that weakness happens at the end of the year. And we saw that play out. But the good news, right, the good news I keep hearing is that a lot of these seasonal trends and cycles start to flip bullish pretty soon. Is that right? And we're in kind of what you call the sweet spot of this aggregate cycle chart. And you've been sharing this aggregate cycle chart all year, and it's been amazing how it's caught some significant turning points. I mean, it pretty much called the summer bear market rally top almost to the day, August 16th ish. You put out a note on your blog saying, if the aggregate cycle is going to hold, this is probably a peak for at least the short term. So tell us a little bit more about this aggregate chart and what are the three inputs into it? And then we'll go through each one of those.
Yeah, I mean, you said it's a sort of perfect storm of seasonal cycles and the presidential cycle. And that's what the main components of this composite, this aggregate cycle are. You've got the midterm year since 46, which is the first cycle after World War II. And all years, and then you've got the second year of decades, the decennial cycle, which I don't necessarily give as much weight, but it seems to have some impact. It's not as easily correlated, and as we've discussed, a lot of those second years of decades are also midterm election years, which we find having more impact on the market. I mean, there's no other government in the world that has regular elections on the same day every 4 years or every 2 years for the midterms. There's the parliamentary systems and votes of no confidence, and I don't know of any major economy or country, and especially not another one that leads the world, that has these elections on a regular basis, which people anticipate. I mean, people that run a lot of money are cycle watchers. They're listening to what the government does and what they're going to do and what they're talking about. And that's a major driving force. And we're seeing it set up quite well here in 02, towards the end of Q3 in the midterm year.
Yeah, so it's the annual cycle, the 4-year presidential cycle, and that decennial cycle. But as you pointed out, the decennial cycle is kind of saying something similar to what those midterm years are, because a lot of those year twos also coincide with. If you
look at a
years,
single
right?
year, from memory, if the aggregate cycle chart here is very similar to 1962.
Yes, yeah, that's an analog I've been hearing a lot.
Yeah, a lot of we've been covering that for a while. So basically, you have all years since 1946, all midterm election years since 46, and all second years of decades since 46 here. Some people go back further. We've discussed why I don't find that as relevant with the change in behavioral patterns. But, this chart shows that we're dipping below that, which is overriding that second year impact, I think, and it's more midterm influenced.
Yeah, and the trend is kind of more important than the level here, right? And the important thing is we're kind of at that crest, right? That turning point, right?
Yeah, I mean, the chart that we're talking about, it's got two vertical axes. It's really geared towards showing trend, which is more important than level here, because the average year was down less than 2% in the aggregate cycle, and here we're down about 25. So
yeah. So let's move on to the annual cycle in particular, that first component of it. And let's focus on October. It's kind of a misunderstood month. Whenever I think of October seasonality, I always think of that famous Mark Twain quote about how October is a peculiarly dangerous month to speculate on stocks. The others are July, June, and so on. So it's kind of meant to be jestful, but it gets a bad reputation. You call it October phobia because some of the biggest crashes have occurred then, right? 1929. Yeah, another bad one in 08, right? But then on the other hand, you also pointed out, or actually your father pointed out, I guess in 1968, as you just told me, that October also has a reputation as being a bear market killer, especially in midterm years. So could you explain that a little bit?
Yeah, turnaround month is what he also said, and what we say. It sits at a very important location in the calendar ahead of the best 3 months of the year: November, December, January. You've got the October 31st distribution deadline for funds. You've got end of Q3, beginning Q4 portfolio restructuring, window dressing, tax loss selling. For that for the funds in their quarter end. And it just sits at this spot of like, it's almost like where two rivers collide. It's like a confluence where you have a lot of action going on, people setting up for the big investment flows that come in towards the end of the year. And you've got the end, like the fourth quarter is a whole different animal. It's like the setup for the new year, whereas there's a lot of quarterly impacts from the funds where the flow is going out and the reporting. But then you get into Q3, which has its own the end of Q3 has its own thing, and then Q4 is like the setup for the beginning of the next year. So that's what creates the seasonality. Everyone starts planning for the next year. I mean, you're starting to look for your summer house already. You got to get that booked up for next summer. You got to see what your plans are for the holidays, and everyone's already talking about. I mean, there's already like Christmas lights up somewhere. It's just, it sits at that spot in the calendar where things change, and the market and the economy and everyone's psyche turns.
Yeah, so that reputation of the midterm bear, you're saying it's kind of the bear killer. I'm sorry, it's just that it's sitting in that sweet spot. So let's get into the 4-year presidential cycle. It's that second input to that aggregate chart that we just showed earlier. Why don't you break that one down for us, and kind of what you think where we are on that?
The post-election year has gotten a little bit better over the recent years, and that's, as I said, that's kind of my job, is to watch these patterns and observe their shifts and document and report on it. But generally, the first 2 years of a president's term, they try to get the nasty stuff out of the way first, and the market doesn't do well. You see wars, recessions, bear markets starting, during that period of time. More so even in the midterm year, as we're living through. And then they start to prime the pump in the third year ahead of the election year, so that you and me and everybody else in the country goes into the voting booths with lots of money in our wallets and back pockets, and kind of happy about what they're doing. And then the election year, has been better. I mean, it's gotten worse over the years because it has become this battleground year where there's a lot of mudslinging, and I mean the constant campaigning that goes on. But that sweet spot and the pre-election year, still the best year of the 4-year cycle. There's only one loss going back to 1939, and this sweet spot is there's another pattern we look at with the sweet spot. It's called midterm elections, bottom picker's paradise. But the gain from the midterm low, whenever it is, a lot of them happen to be in October, as I'm sure you can imagine. But the gain from the midterm low to the pre-election year high is about 48% for the Dow and about 68% for the NASDAQ, going back to 71. So, wow. And a lot of those, and you can even see it on this sweet spot chart that we have, that a lot of those highs in the pre-election year are at the end of the year and almost on the last trading day of the year. So the bulk of that run is the 3/4 sweet spot from Q4 in the midterm year to Q2 in the pre-election year.
Yeah, I've been sharing this similar chart from Ned Davis Research. and it basically shows the presidential cycle like you have here, but then under it, it has the liquidity cycle. And you can kind of see how that might be driving that cycle, and how, right towards the end of year two is when that sitting president starts to think about reelection, and what can they do to stimulate the economy and all that. So it's definitely an interesting one. But another one that caught my eye is this chart you have here, which basically shows that not only our midterm years tend to be weaker, but when there's a new Democratic president, it's kind of the worst of the scenarios. Is that true?
Admittedly, not the largest statistical data set when you start to talk about new presidents' midterm years. But yeah, I mean, think about what presidents try to do. They have agendas, policy initiatives. Democrats tend to do a lot, more of a progressive minded, ideology. And you can see right here, they just, come in and sort of, I don't know, mess with things, screw things up, for lack of a better word. And it's happening. And, this year's playing out just like that.
Yeah.
Maybe it's the, policies of more regulation and trying to do, work with every single
yeah. What I found
issue, hot button issue.
What I found interesting here is that, when you look at it from a new Democratic president, when you look at that cycle in a midterm year, that one tends to bottom more towards the end of October. Is that right? Whereas some of the other ones bottom a little earlier in October.
Yeah, that's why I'm being patient here. Everyone wants the bottom to happen, sooner than later. And we've already taken out the June lows, not for NAS so much, but we're going to wait for the technical. I mean, you're a chart guy. We're going to wait for, I mean, we're not just pure seasonal. I mean, we overlay, right. and I look at fundamentals more than the technicians in the room, but there's ways to use all three disciplines to pinpoint things a little bit better. So we wait for a technical trigger to get in, and I'm not going to rush into that. We do that with our best 6 month switching strategy. Simple MACD. You wait for that, indication that momentum shifted. So,
and I'm glad you brought that up, because we're not just looking at this in a vacuum. You might be looking at the fundamentals. I know you're looking at price too. Here we are breaking those June lows, so or at least flirting with them. So as you said, you're being patient. That's probably prudent. But let's move on to this other chart you have here. Tell us what's going on here.
Yeah, everyone says the old saw, Democratic or Republican presidents are better for the market, and it's really about Congress because they hold the purse strings. So this is a chart that shows the different political alignment, makeups with Republican presidents, Democratic presidents, whatever Congress is. Gridlock tends to be best. You've got presidents trying to push through certain policies where there's a opposing Congress trying to, keep a little chain on that, a little governor. And what you can see here is the best combination is a Democratic president and a Republican Congress. You've got a conservative body holding the purse strings, more, sort of progressive body or branch trying to make changes. And, at least in the old days, they would come up with some sort of compromise that was a combination of, being frugal, prudent, and, progressive. So that's what's been that combination where the Dow's up about 16.4% in years with a Democratic president and a Republican controlled Congress, both houses.
Yeah, so just to bring it all back to that aggregate chart we shared earlier, we covered the annual cycle, right? October, especially, midterm years tends to do that. And then, of course, I just mentioned it, but the 4-year presidential cycle and that decennial cycle, when you put it all together, the phrase you came up with, buy in October and get yourself sober, right?
But you had to come up with an answer, a rhyme for sell 'em and go away, right?
Right. So you didn't come up with sell 'em and go away, did you?
That's an old British saw. That's older than, I think it's older than my father, even, who's no longer with us. It comes from a different seasonal observation. The old whole thing, I mean, everyone here is sell in May and go away, come on back on St. Leger's Day. St. Leger's Day is the day of the St. Leger's Stakes Thoroughbred horse race, which is the final leg of the British Triple Crown, but it occurs in like late September, and it's the last horse race of the season. And, the London season goes from, September, October to May. Used to get really hot and horrible in London. Everyone would go up to the country for their fox hunts and all that sort of thing, but it still it still works that way, where most of the business investment bankers and merchants do all their work in the fall and winter, and then when spring comes they go for some sort of more fresh air activities outside of the city, and that tends to have business slowdown, and that's where we get sell in May and buy in October.
Yeah, so that best 6 month strategy, and that's one of the phenomenons or strategies that you guys have kind of popularized over the years. And I think it's a fascinating strategy. And you combine it with the MACD indicator. Could you kind of explain how you use MACD on top of these seasonal trends to produce above average gains?
Yeah, it increases the results from just using the plain, best 6 months, which is October 31st to April 30th versus April 30th to October 31st, or whatever the last trading day of those respective months are. But we start looking for a MACD trigger, a crossover, and the chart here kind of depicts that. On the sell side, we look at the 12-26-9, which is the basic MACD that a lot of people use for everything. That's what we call the slower or longer term MACD. And we start looking on or after April 1st for a fresh crossover of the MACD line through the signal line. And then when we go to the buy period, which is October, the last month of the worst 6 months, we start looking for a crossover on or after October 1st of the 8-17-9, which is a shorter, faster MACD, because as you know, bottoms are more of a process. More of an event. Happen quickly, hopefully soon enough here, too. But we'll wait. And then tops are more of a process. They take a good amount of time to form, and it seems to work best. We've looked at other MACDs, and these are the two original ones that Jerry Appel, the creator of MACD, came up with. Just had breakfast with his son Marvin a couple weeks ago, and it has improved. MACD in general, whether using it for seasonal trading or otherwise, is used to confirm another decision, another analysis, whether it's some other technical work you've done, fundamental work, some sort of just stock picking where you like a company, what they're doing, their products, or whatever the reason, or you get a tip from somebody, but you use MACD to time that entry or exit better. So it's a confirmation of some other analysis. And here with the seasonal analysis, we use it to confirm the entry or exit, or improve the entry or exit into and out of the best and worst months.
I guess I've never thought about MACD that way, but I've always loved this chart. You have it in the Almanac, and it basically shows if you started with $10,000 in 1950, what your returns today would be if you had just bought and hold. That's that white bar there. If you would use the best 6 months and MACD strategy of yours, you'd have about 3 million, right? And if you had only done the worst 6 months, you would actually be at a loss, right, of $4,000 over that time period. So it really is a powerful strategy.
And it doubles the results, almost triples them of just doing the best 6 months on the end of October to the end of April.
Right. And I've seen these results without the MACD component there.
Right.
And they are different. So adding that MACD as confirmation, as you said, is I think that's the secret sauce, maybe. But
it's no secret.
We're running out of time, but before you go, where can people find more of your work, and where can they pick up a copy of of this next year's Almanac?
Well, the 03 is coming off the press pretty soon. They can pick that up wherever books are sold, or give us a call. I don't necessarily sell the individual copies myself, but it comes with a subscription to my newsletter, which is at stocktradersalmanac.com. And you can follow me at Almanac Trader on Twitter. Those are the two best places to get a hold of me, also on LinkedIn. But stocktradersalmanac.com is the best place to go to find out what we do. You can get a free trial there, see some of the analysis and recommendations that we make. And there's a little offer code. You can go to click get STA. I've got it here if you want to show it to people.
Sure.
Usually $19.95 a month, but $150 for a year or $250 2 years. We're about to be raising some rates, so people should come in now and get the 23 Almanac when it comes off the press.
Yeah, I mean, it really is a great resource. Like I said, I get it every single year. I love the quotes in there. I admittedly steal some for the chart report here and there, so I hope you don't mind. The stats are awesome. And also, I think it's a great trading journal too. You know, I sometimes will flip to the day that it is, and I'll just jot some notes.
That's
about,
how it's supposed to be used, man. That's what it's
yeah.
there for. I still write stuff down there to myself.
Yeah, it really is like the farmer's almanac for traders. So it's really a great resource. Anyway, Jeff, thank you so much for coming on today. And I'd love to have you back sometime in the new year after we get those Santa Claus indicators and the January indicators. I'm sure we'll have a ton to talk about then.
Most definitely. We'll probably have our midterm bottom and we'll be rallying already.
Well, fingers crossed. Let's hope, right?
That's right.
Well, anyway, have a great weekend.
Thank you. Appreciate it.
Take care. Well, thank you guys for watching. If you enjoyed this show, be sure to click like and subscribe, and definitely check us out at www.thechartreport.com. Subscribe to our newsletter. There's a ton of great stuff in there, and have a great weekend. Thanks.